After covering the huge tech companies, today we'll take a slightly different path. We'll look at the stocks of stable companies which may not guarantee such high growth, but on the other hand, pay solid dividends and tend to perform well even during crises.
Boring.
And a crisis can come at any time. We'll start with a company in which Warren Buffett owns nearly a 10% stake. Yes, you guessed it, Coca-Cola. You probably know it's not just about Coke. This company also owns other soft drinks like Sprite, Fanta, Schweppes, and Kinley Tonics, and Fuse Tea. They also have Minute Maid juices, Smart Water, and Dasani mineral waters, and last but not least, the Costa coffee chain. In most cases, we're talking about products that people buy daily in stores. And even a financial crisis wouldn't change that. That's why Coca-Cola is considered one of the best-known defensive stocks for crisis periods. Since the start of the year, the stock has added a respectable 14%, though this is mostly thanks to a rebound after a drop from November to January. In February, great results came in, bringing the growth we've mentioned. The latest results in July weren't bad either, and according to analysts, the current share price is about 10% below their target. Add a dividend of around $2 per share, and you've got a nice stock for portfolio diversification. Their competitor in the market is PepsiCo. Again, it's not just about Pepsi. They also own Lipton Iced Tea, Mirinda, 7-Up, and Gatorade. PepsiCo also ventures into snacks, owning brands like Lay's, Doritos, and Cheetos. However, PepsiCo has been lagging behind its rival recently. The stock is down 3% since the start of the year, and down 15% over the past year. While Coca-Cola delivered about 50% returns over the past 5 years, PepsiCo managed just 5%. In the last quarter, Pepsi's net income was about $1.25 billion, while Coca-Cola's was roughly 3 times higher, even though Coca-Cola's total revenue was only about double. PepsiCo does have one edge, though, a higher dividend yield of about 4%, compared to Coca-Cola's roughly 3%. We'll stay in the beverage sector a bit longer, but this time we're heading into the alcoholic paradise, to the British company Diageo, which is also traded on the New York Stock Exchange at just over $100 per share. But their recent performance hasn't been very positive, quite the opposite. Since January, the stock has lost 10% of its value, and it's been declining steadily for nearly 4 years now. Yet Diageo owns Guinness Beer, Tanqueray Gin, Bailey's, and Captain Morgan rum. Although, to be fair, these days some might prefer a sip of motor oil over Captain Morgan. The company's main challenge is the gradual shift in consumer habits, as younger generations are slowly but surely drinking less and focusing more on a healthy lifestyle. On the other hand, their financials aren't all that bad, and the stock price is currently at levels seen back in 2016, which could make it interesting. Now let's add some solid food into the mix with another brand you'll easily recognize, the Swiss giant Nestlé. Their portfolio also includes drinks like San Pellegrino, Vatel, and Nestea, as well as coffees from Nespresso and Nescafé. But they're even better known for products like Kit Kat, Smarties, and classics like Nesquik or Chocopic. They also cater to pets with brands like Purina and Friskies. Nestlé trades on the Swiss Stock Exchange at around 70 francs, and since the beginning of the year, it has fallen by just under 5%. In Q1, however, the stock was up by about 25%. Like Diageo, their performance in recent years has been rather flat, though analysts are slightly more optimistic here. Nestlé maintains a solid 4% dividend yield, and their revenues remain very stable. Despite the recent lackluster performance, we still see it as an interesting stock for diversification, especially given their huge reserves of drinking water. It's worth noting, however, that this is also one reason why Nestlé is sometimes labeled as the evil company. And finally, a sweet ending with Mondelez. Their stock has gained 3% since the start of the year, though it's still down 10% over the past year. Their products are well known. They own 7 Days croissants, Milka, Toblerone, and Cadbury chocolates, Oreo cookies, Philadelphia cream cheese, and Tuck crackers. The Chicago-based company pays dividends like others in the industry, $2 per share. This year, they've beaten analysts' earnings per share expectations in both quarters, yet the share price remains relatively low. Their revenues are very consistent and tend to grow over the long term, which is why analysts' target price is about 20% higher than today's. However, as with others, the outlook is slightly clouded by the global shift toward healthier lifestyles. Even so, it's one of the more interesting companies we've discussed today. So, what do you think? Do you have any of these companies in your portfolio?